Welcome back. That's the ITC numbers, 2,425 crores. That's very close to our estimate of 2,450 crores. So it would be a growth of around close to 10%, 9 to 10 odd percent is what ITC has reported this time round. So it's very close to our estimates in terms of what we were estimating. So it's a growth of around 9 to 10 odd percent for ITC on the bottom line. That's the only figure that we have for you. We are expecting a top line to surge past 9,000 crores, but now we're going to wait by for the P&L to come out and get you more of the details. At this point in time, the stock is just about trending with a gain of around 1 odd percent, and it's a sub 9,000 crore figure on the sales figure. It's 8,930 crores versus an estimate of 9,063 crores. 9,000 is just that optical figure that we were working with, but it's very close to our estimates, 8,930 crores as compared to our estimate of 9,063 crores. I think we have Suruchi Jain, the equity research analyst at Morningstar, joining in as well. Suruchi, your first thoughts on ITC?
So I think we were expecting a overall sales growth of 14% for the full year because we look at mostly annual numbers. The two figures that are very key for us are cigarette sales growth and cigarette margins. So we're expecting cigarette margins at 34.5% and cigarette sales growth at 13%.
Okay, but just based on the revenues as well as profits, Suruchi, do you think it's a bit disappointing because revenue growth has only come in at 14.8%, so it's much lower than the 25% that was clocked in the previous quarter. It's lower than what the analysts were estimating even in this quarter. So based on revenues and profits for the quarter, would you be a bit disappointed?
No, I think the revenues are not disappointing because I think at least last quarter was a little higher than what we had expected. So the revenue is definitely not a disappointment. On the profit figure, like I said, there are a lot of segments that they play in, and the key one will be the cigarettes.
Okay, let me give you those numbers. The cigarette revenues have come in at 4,250 crore, which means it's a growth of close to about 14% that it's clocked in terms of a year-on-year basis. And cigarette EBIT has come in, I think, at 2,882, which is a growth of 12.2%.
And one more key point, Rima, it's the other FMCG EBIT that we were looking out for this time around, and that's coming at a loss of around 10.31 crores, which compares to a loss of 15.56 crores in the last quarter and 12.7 crores in the same quarter last year. So it's still a loss on the EBIT, on the FMCG EBIT, and the margins flashed by for you. So if you could just pull up the margins for you again, it had just flashed by. That will come up for you as well. But your thoughts, Suruchi, in terms of the cigarettes business and a couple of parameters that we read out for you?
So I think the profitability has gone down a little bit, and I think that is definitely a concern for us on the cigarette front. And on the FMCG front, the fact that they've, again started spending on more and more expansion on that front, we think it's not a very good use of capital. Because they've already taken about 10 years to come to a 0.1% EBIT margin last year.
All right, just one more key point for you, Suruchi. It's the margin which has come in at 38%. That is in line with expectations. And the entire EBIT has come in at 3,395 crores. So the management has managed to maintain the margins of around 38% odd despite the revenue not meeting expectations that the street was possibly working with.
Okay, the margin number, that you're telling me sounds quite robust, and it's actually higher than what we had expected. So, like I said, we were working with a 34.5% number for the cigarette business, and we were actually hoping that the FMCG would be a positive. So that's a little bit of a disappointment. So it seems like cigarette is still pulling most of the weight as far as profitability is concerned. And, if the company stops spending more money on the FMCG growth, then that could, the profits could really reflect in the P&L more robustly.
Well, speaking about the profitability, which has helped in the margins coming in at 38%, the cigarette EBIT has actually gone up if you look at it on a quarter-on-quarter basis, though it's lower on a year-on-year basis. It's come in at 67.8%, which is down compared to 69% in the comparable quarter of last year, but it's an improvement compared to 64.8% QOQ. Apart from that, the agri business has also managed to report an improvement in margins on a QOQ basis. Agri business EBIT has come in at 14.5%, better than the 16.1% in Q1. Other than that, you still have a loss in the FMCG others business as well as hotels. So hotels continues to have a loss of close to about 9.5 crore is what they've reported. In terms of the segmental revenue growth, 14% for cigarettes. Agri is done well again with 16.1%. We'll be joined by Naveen Kulkarni, the co-head of Phillip Capital. But quickly, let's go across to Pragya and get in all the details and her take on the numbers. Pragya?
Well, thanks a lot for that, Seema. This time on the top line front, this would be the third consecutive quarter that we were expecting a 9,000 crore plus kind of a sales from the company. They've just fallen short marginally of that 8,930 odd crores. It's a growth of about 15% that they've managed to deliver. So that would be the one miss that I would want to highlight. Apart from that, on the operating margins, the company's delivered 38 odd percent, which is a decline of about 170 basis points on a year-on-year basis. We were working with a much less decline number, just about 90 basis points. So that's the other big disappointment in the figures. The profitability is looking much higher. You guys pointed out the higher other income that's gone up substantially, 45% jump on a year-on-year basis, coming in at 356 odd crores. You were highlighting the cigarette performance. This is the second quarter now that the company stopped reporting the gross sales. So we have the net sales number with us. That's gone up by about 14%. The EBIT in this segment, remember, we were working with a growth of about 12 to 14%. So that's largely in line. Remember, the company had a very high base of 21% that they had to deal with. We saw that in quarter one, the growth in the cigarette EBIT had actually accelerated to almost a 19-quarter high. So it was difficult to match that kind of performance. But if you see sequentially, there's not much of worsening that we've seen in the cigarette business. So while in the last quarter, the revenues came in at 4,200 odd crores, they've managed to hold on those levels in the business on that front. On the cigarette EBIT front, just about managing to hold on the performance there. Of course, the margins in this segment have gone up because all of those incremental price hikes now forming a part of the base have actually helped the company. The FMCG others business loss is a disappointment. In the hotels business also now for the second consecutive quarter, the company's reported a small ticket loss of about 10 crores. The revenues in this business have gone up by 6%, so that's not looking good. The other disappointment has come in from the agri business. We were working with a much aggressive growth number of close to about 35 to 40%. Here in the company's delivered just 16% growth. So all of that has led to a tad bit of a tempering of the top line versus the expectations. And agri and paperboards, of course, has done well for all the price hikes which they've taken. I would say, compared to what the company delivered and started this financial year with in quarter one, they've not been able to hold up that kind of a performance. There would be a volume decline that I would estimate of close to about 2% on the back of these numbers. It's just a rough calculation at this point. But all in all, I would say that, compared to the lofty expectations that the street had with the stock, it's a tad bit disappointing on that front.
Okay, Pragya, if you had to pick out one of the key disappointments this quarter for ITC, even in terms of a segment, which one would it be and which one would possibly be a positive for you or the most positive parameter that's come out from ITC?
No real positive actually, except the fact that there's no deceleration on a sequential basis in the overall performance. But that itself, is a tad disappointing because the 67.8% margins is much lower than 69% that they've done in the cigarette business. Actually, it's hard to pick out any kind of positive in these numbers. I would say, it's tad bit disappointing for me compared to the expectations that the street has. It's just a resilient performance, but compared to, what we have come to expect of ITC, from that perspective, it's a tad bit disappointing.
Okay, Pragya, thanks so much for that. Quickly then, let's go across to Naveen Kulkarni, co-head of research at Phillip Capital. Hi, Naveen, your initial reaction to ITC numbers and what stood out for you?
Yeah, overall the numbers are in line. The EBITDA number is lower than our estimates. Reason being, I think agri-business has been slower. But I would say overall, essentially ITC profitability lot depends on cigarettes. So that has done reasonably well. Also, it is important to remember that excise duty hike came in July. So it would have been effective in the market, as in company would have sold inventory till August. So that would have also helped the profitability. So I think September would be the month when they would have sold the new, paying the higher excise duty. But the EBIT growth in the cigarettes business looks fairly strong. So that's the positive. And in the FMCG others business, the growth is still slow, still quite sluggish, 12% revenue growth. So that's not great. Hotels, agri business, and paper boards are not very inspiring.
Okay. How would you rate its performance on the EBITDA this time round? It's managed to maintain margins at 38% despite maybe there being a little bit of a shave off in terms of the revenue.
Yeah, see, the important feature for ITC to note that is on a consolidated EBITDA basis, the picture can be very murky because businesses like agri, there is a lot of commodity component involved. The revenues might look higher, but the margins might look a little lower. So if one has to look from an absolute perspective, I would say that there has been a marginal miss in the EBITDA number. So that's not very, very encouraging. But on the other hand, I would again reiterate that the cigarettes business is what drives the profitability of the company still. So that's done reasonably okay. So I won't say that the numbers are particularly weak. It's inline kind of numbers. Maybe the surprise that people were expecting that has not come.
Okay, Naveen, thanks so much for taking the time out and giving us your perspective on ITC. It's come off close to about 1.5% from the high point of the day. It's largely in line with a shade of disappointment. It's a wrap on Halftime Report from Ekta and myself. Thanks so much for watching.